Hey everyone, welcome to this week's stock and macro update. So this week I'm going to go over two more stocks in our disruptors index, which are Cameco and MP Materials. Then I'm going to go into the overall performance of the index versus the overall market over the past week. Then I'm going to get into my thoughts on inflation and the Fed and what happened last week and what we're seeing in the market as a result. So let me go ahead and get started with these two companies. So starting with Cameco, this is another uranium company. Last week I went over Energy Fuels, which is a small, mostly US-based uranium producer. Cameco is kind of the opposite. They don't have any active operations in the US, although they have two mines that they are kind of just waiting for demand to continue to go up and show consistency, and then they'll put those mines back online. But primarily, they operate in Canada and Kazakhstan. So these are, I believe, two of the top three, if not the top two, markets for uranium in the world. And they actually have a 50% ownership in Cigar Lake mine, which is the number one mine in the world, and a 40% ownership in the second largest mine in the world, which is in Kazakhstan. So they are a huge producer. They actually produced 9% of total uranium production last year on a global scale. And I think that obviously with all that going for them, they're going to be a huge player in the uranium market as it continues to boom. So as I went over last week, with everything going on in Europe and Japan and all these countries that are struggling with energy costs right now, and especially Europe, they are once again turning to nuclear, which they had planned on really downsizing their capacity for nuclear. Now they're starting to rethink that. So there's going to be, and the same thing is really happening in the US. So there's going to be so much demand for uranium producers, and it's going to do a total 180. And we're already starting to see this. And in the most recent earnings call, the Cameco CEO actually said he's never really seen demand intensify like it is right now. So definitely great things going on in the uranium market, and I think Cameco is going to be a winner there. Getting into rare earth metals. So this is what MP Materials specializes in. Rare earth metals are very useful for especially magnets. They're known as the best kind of magnet material in the world, and magnets are crucial to alternative energy. So they're used in electric motors of all kinds, any kind of electric vehicle or even accessory, as well as wind turbines and things like that. And they have a lot of other applications too, like they're used for MRIs in healthcare. So there's a lot of demand for rare earth minerals going on right now. China has been primarily the dominant player in this industry for about 30 years at this point. But recently, this company just acquired Mountain Pass mine in California or Nevada, and they brought it out of bankruptcy in 2017, started operations again. This is, I believe, the second largest operational mine in the world in the rare earth industry. So it was a huge move for them, and now the US actually produces the second most rare earth materials in the world out of any country because of this sole mine. It is still the only operational rare earth mine in the United States. So there's a huge market for this company, and I think that they're going to be a dominant player there. And just to touch on financials for both of these companies real quick, mostly focused on cash flow, as I think that's going to be a huge driver of demand for stocks going forward as inflation is high, rates are high. Companies that rely a lot on debt and don't have a lot of cash to fund their operations are going to be in a tough position. So just to give some stats on that real quick, Cameco has about $1.1 billion in cash versus a little over $800 million in debt. Mountain Pass Materials, or MP Materials, has $1.26 billion in debt versus $685 million in cash. So both of these companies have hundreds of millions of dollars worth of cash even left over. If they were to pay off all of their debt today, they'd be set still with the excess cash that they have on balance. MP Materials, they're still in rapid growth phase right now because, again, they've only been operational for 5 years and they're already really dominant, other than China, dominating the rare earth industry already. So the first half of 2022, they actually generated 133% sales growth from the first half of 2021. So that was a huge thing to see as well. Now I want to get into performance for the Disruptors Index. So tough week over the past week. This measures Monday close to Monday close. So as of this Monday's close, the weekly performance was negative 11.03%. versus S&P 6.24% loss, NASDAQ a loss of 5.73%, Russell 2000 loss of 9.06%, ARKK, the kind of the growth index, minus 11.91%. So they had actually a bigger loss than the disruptors index. The Russell 2000, which is mostly small caps, a lot of growth in there too, obviously did several percent worse than the S&P and the NASDAQ as well. The top three performers in our index, Bitcoin and Ethereum, were actually the top two. So Bitcoin minus 1.59, Ethereum minus 2.38. No gainers in the past week, unfortunately, in the index. Again, very tough week. Then rounding that out in third, Cadence Design Systems, CDNS is the ticker, with a 2.88% loss. The bottom three performers, this gets pretty ugly. So Plug Power, PLUG is the ticker, negative 21.72%. Desktop Metal, a loss of 20.85%. Energy Fuels, Desktop Metal's ticker is DM. Energy Fuels, which is UUUU, the other uranium company, took a loss of 19.1% over the past week. So again, rough week for energy stocks, especially oil was way down, and usually when that happens, it takes, at least in the heat of the move down, it usually takes a lot of other commodities and energy stocks with it. All right, so getting into inflation and interest rate projections. So obviously last week at the Fed meeting, Powell and company raised 0.75% to the Fed funds rate, which is the baseline kind of interest rate for the United States. And that is sitting now in a range between 3 and 3.25%. So the 0.75% increase wasn't really a surprise to anybody. Everyone was expecting this going in. But one thing that it did really affect is the Fed funds futures market. So it kind of, or Powell's language at least, must have kind of spooked people just based on what we saw in the market as a reaction to that. And as well, it kind of spooked the futures market for the Fed funds rate. So there's a whole separate futures market that tries to speculate what the Fed futures rate is going to be at any given point. Usually has monthly expirations. So something interesting happened after that meeting, which is that the expectations for the Fed's rate policy in 2023 changed pretty drastically and is now projecting almost a 0.4% increase in the Fed funds rate in 2023. So now the market's expecting rate hikes in next year instead of rate cuts. So this is a wild 180 from what we were seeing in July, back when this the projection for 2023 was actually a decrease of 0.6%. So it's gone up a full percent. Now it's 0.4%. So back when it was negative 0.6%, that means that the projection in the market was that the Fed was actually going to cut rates by 0.6%, which is about 2.5 of the standard rate hikes / cuts, which usually move at 0.25%. So I don't really track this futures market as, saying that this is what the Federal Reserve is going to do. I kind of see it more as a sentiment indicator, and when it spikes like this, like it has been over the past week or two, it shows that something unexpected happened, and all of a sudden the market's very pessimistic. So that's what I'm seeing right now. Obviously, we can see that in the indices too, with the Dow making a new low last week. The S&P just made a new low today as I'm recording on Tuesday, and I'm not sure about the NASDAQ, but that probably has made a new low as well. So markets are spooked from this, not necessarily from the 0.75% hike, because that was priced in to the markets overall. You can see that in the bond markets, but I think that the language kind of scared investors in general, bringing back that pessimism that we saw in June and May. One thing that's different is that growth stocks aren't going down as much. So ARKK, the growth proxy index that I kind of use, hasn't made a new low. So that's something to watch for sure. Some growth stocks actually that I have and that I watch have actually, barely even gone down over the past week. So they might be down like 4 or 5%, which isn't a huge move for a growth stock. This happens week to week anyway. Versus the S&P, which is down even more than that and making a new low. Some of these growth stocks are even like 20 to 30% off their lows to the upside still, and haven't made a new low since May. So There's definitely demand there for growth stocks, and the fact that they haven't made a new low along with the indices right now is definitely something interesting to keep an eye on. So this Friday, we're going to see the PCE numbers, so personal consumption expenditures. This is an alternative method of measuring inflation to the CPI, and the Fed actually likes this one more. They like core PCE especially, which excludes food and energy, so it really measures discretionary spending, which is what they can curb by raising rates and doing quantitative tightening. So if they see that, in August, discretionary spending was up, it was in CPI too, so it probably will be in PCE. I don't think it'll cause much of a stir in markets, but it would confirm with the Fed that they are not going to be easing things too much, at least in the short term. So they might not do, 75 basis point hikes in November and December. I actually don't think that'll be the case. But just based on the discretionary spending, that's really what's going to be the determinant, I think, of when they actually stop raising rates. So in order for that discretionary spending to really come down in a meaningful way, and I think they're going to need to see, core PCE, core CPI probably move down for like 3 or 4 months at least in order to stop raising rates. And I don't mean the overall year-over-year percentage, I mean month-over-month declines overall. So month-over-month deflation for at least 3 or 4 months in those core inflation readings. There are two ways that this is going to happen, I think. So one of them is a resurgence in energy prices, which obviously none of us want. Actually, none of us want either one of these things. But this would be the worst case because a resurgence in energy prices or food prices, and food prices really haven't even gone down that much. A resurgence would mean that inflation isn't going away, discretionary spending is going away, but inflation would still be there in energy and food prices. So that's the least ideal scenario. Another non-ideal scenario, but something that is probably going to happen to stop this discretionary spending, is pain in the labor market, which I don't see happening for at least 4 to 6 months because there's still so many job openings. There's less than there was before by like hundreds of thousands, but there is still like 1.8 job openings for every unemployed person looking for work. So the labor market is still very, very strong. It's a matter of how many jobs can actually pay people and keep up with the inflation. But as long as people are employed, they're gonna spend, whether it's on higher energy, which they have to kind of do, or if energy costs are low, they're going to go out and probably spend even more on other things, and that's the discretionary spending. So there are a couple ways out of this. Neither one of them is exactly fun, but I think that's what the Fed is going to need to see in order to stop rate hikes. Until then, I think that they're probably going to do maybe a 50 basis point hike in November, maybe 50 in December, probably not though. It really depends on discretionary spending and the labor market conditions. But next year, I think they're going to just keep doing 25 basis point hikes until, the economy is hurt enough, essentially, to stop doing that. Because if they stop doing these rate hikes and they actually start easing, that would be, short term, people would be happy because the market would go up. But that would be absolutely terrible for inflation because, when people get stimulus, when the economy is stimulated, that drives inflation up, and that's the last thing we need right now for the mid to long term. So that's what I'm seeing right now. That's my projection for the Fed actions, inflation, and everything like that. So just a reminder, the way I position the 21 Disruptors Index is actually to benefit from a high rate environment where the bigger companies, older companies that rely so much on debt are not going to do as well, that don't have a lot of cash on hand. That's not the position to be in right now. And a lot of these growth stocks, not only do they have a lot of cash and relatively small amounts of debt, but they also have sales that's outpacing inflation, which a lot of these other companies that are older and bigger and in decline do not have. And they also, they don't buy back hundreds of millions of dollars worth of shares every quarter, or even billions in some cases, like a lot of these companies. They don't pay dividends, so that just means more cash to act as a buffer and more cash to fund their growth going forward. So, even though we've seen some pain in growth stocks, that, these companies, they really haven't been making new lows with the indices, which I think is a huge deal. So the ones that aren't making new lows are definitely the ones to keep an eye on right now. And I think that these cash-heavy companies, the market, every single earnings season going forward, where we see these companies that have high debt, where we see them disappoint on earnings, and even if they make it sound good, we're still going to see the data that comes out. It's probably going to be worse each quarter, at least for the next year, as long as rates stay high. These other companies are going to get more and more notoriety as having high cash and not nearly as many obligations for that cash. So that is key right now, and that's essentially how I structured the index overall. And these stocks are going to be in demand at least in the mid to long term, and probably even in the short term coming up here soon as well. So that is it for this week. Thank you everybody for watching. I will see you again on Friday with the crypto update.